Welcome to the HMO Property Show. By investors, for investors. Catch us weekly as we discuss all things cash flow positive property investing. Whether you're a seasoned investor, a new landlord, or just curious about property investing, this is the podcast for you. Sponsored by the Co-Living Collective, your trusted partner in creating vibrant and sustainable shared living experiences. Visit us at colivingcollective.com.au to learn more.
Welcome back to the HMO Property Show. I'm your host, Neil Gibb, and this week we're going to talk about the federal election, unpack it and talk about what it means for you as an investor and where the opportunities and potential advantages are for you in the market. Before we get started, I just want you to know that I actually forgot to vote, and I forgot because I didn't put too much importance on it because I actually don't care who is in this seat. Same as when Trump got elected, it didn't make any sort of difference to me whatsoever. And the reason being that is because nobody is going to affect the outcome of my life. Things might change because of the policies that they put in place, but I'm definitely not going to hang my hat on it and say I really want this person to get in and then be devastated when they didn't get in. Either way, I think both parties are pretty useless. Probably prefer Labour, but I'm definitely not concerned that Labour are in. And there's some good reasons for that. So let's unpack the podcast today, right? So let's talk about politics in general, right? Because I didn't know a few of these things. I've only been in the country 15 years and I've always, for some reason, supported Liberal. Same in the UK because of the small business thing and just because I've been lazy and never really looked into it. But as a property investor, there's some advantages for you knowing who is in and what they can do or what their plans are once they're in power. And today we're going to talk about that. So what's the coalition? I didn't actually know what the coalition was because the coalition collapsed apparently to 39 seats. And the coalition is an alliance of the Labour Party and the National Party, and typically leaning towards conservative economic policies or business-friendly reforms and limited government intervention. Historically, they advocate for lower taxes, less regulation and reduced government spending. And they were in power for nearly a decade before Labour took over in 2022 when Take It Easy Albanese took over, and he's been in the seat ever since. In 2025, the coalition collapsed to just 39 seats. As we said, Peter Dutton, the opposition leader, lost his own seat, a rarity in Australian politics, and the coalition campaigned heavily on cutting migration and reining in inflation, but failed to connect with mainstream voters who were concerned with housing, healthcare and cost of living pressures. At the Labour mandate, Anthony Albanese, Take It Easy Albanese, his Labour government refused to return to power with 85 out of 150 seats. So that's a massive majority and gives them the ability to legislate most of their agenda without major opposition. Labour positions itself as a party of progress, inclusivity and economic balance. Their pitch was invest in people, infrastructure, housing and renewables. If we think about that, that is the things that we need right now in this country. We need more people, but unfortunately there's nowhere for them to live. We need to build the infrastructure and the housing for when these people turn up, but we haven't got the people here to do that because everyone's stretched. And renewable energy is a big thing right across the globe anyway, right? So Labour are talking about investing in that too. But what is the federal election and why it actually matters for investors? Federal elections shape the economic and regulatory environments for years to come. The policy that they can implement can affect lending, immigration, taxes, incentives, planning and construction. And this is why smart investors track politics just as much as prices. What this result gives us is certainty, and markets don't like volatility. People sit on the fence when there's uncertainty in the market. So certainty brings people into the market. And this dominant Labour result gives 5 years of predictable policy, and that's important for everybody that's deploying capital. We've been speaking to lots and lots of family offices, high net worth individuals, and just people with lots of cash ready to invest. They've all been sitting on the fence. They've been waiting for this, and they've been waiting for the cash rate to come down. And depending on what day you're listening to this, the cash rate will be getting announced. I think it's next week or the week after. It's confusing because they normally do it on the first Tuesday of every month, but for some reason in May they decided to do it on the third Tuesday. Typical government thing. But yeah, when that cash rate does come down, along with all of this new stuff that we're going to talk about today, I think that's going to be very, very interesting for the market. And if you're a property investor, which if you're listening to this podcast, I dare say you are, then there's opportunity for you to make and increase your wealth, and which can put you in a really, really strong position moving forward. So number one, let's talk about migration. As we know, population growth is probably the biggest driver of housing demand. Under Labour, Billions net overseas migration reached a staggering 528,000 people in 22-23, while government forecasts show this easing to 260,000 in 2025-2026 and stabilising at around 225,000. That mad spike of 528,000 has already put intense pressure on housing, and no matter where you're looking right across the country right now, it's absolutely bonkers. So let's break down some of this population stuff. There's 197,000 international students arrived in February 2025 alone. Nearly 200,000 students aren't the HMO market, but it does put pressure on housing because guess what? They all need somewhere to live. There's over 850 international students living in Australia today, and that's roughly 3% of the entire population are students. That's quite staggering when you think about it. Melbourne, as we know, the education state. I didn't actually know that till I went there and I seen it on the number plate and I was like, why do we call it the education state? A lot of these people will be living in Melbourne. But if you've followed us for a while, you'll know that we don't really target students. We target working professionals and essential workers because there's a lot of student accommodation out there, and a lot of universities are actually building student accommodation now too. So that's why we don't target them. The wave of migration that we're seeing now isn't a one-off event. Labour's continued support for high migration is a strategic move to fill job shortages, fuel economic growth, and offset the impacts of an ageing population. And migrants typically settle in capital cities, putting immense pressure on rental markets and infrastructure in already stressed suburbs. This influx is one of the key reasons why vacancy rates are at a record low and that rents are surging. So international students, you've got skilled workers, all need housing. And with limited new supply coming online, demand is outstripping what's available. This will continue to drive up rents and create competition amongst tenants, benefiting landlords who can provide quality accommodation. And if the rents are going up, that means people will pay more for the properties because the yield is there to support that increased purchase price. This is just supply and demand 101, isn't it? Labour's property-related politics. We're going to talk about what they've already got out there now because you can probably already benefit from this, and we talk about what they're planning as well. So the number one is the National Housing Accord, and the Accord is a federal government flagship housing agreement aiming to deliver 1.2 million homes over the next 5 years, and they have allocated $3 billion to this. $3 billion is being offered to states and councils who hit key milestones. So $3 billion, 1.2 million homes. That means $333,000 per dwelling. And to be honest, $333,000 will probably get you to lock up nowadays. And that's without the land. It is very, very expensive to build a house. That needs to be more closer to $500,000, maybe $600,000 to purchase the land and build the houses as well. Especially you think about Sydney and Melbourne. I mean, Jesus wept. But even Brisbane and Perth, you know, land alone in Perth now, unless they're picking up like small blocks of land, but then they'd have to build double story. You can't even build a double story for $333,000 at the minute. So I don't think that number is very realistic. Yeah, the $3 billion, but they might only build 900,000 homes instead of 1.2 million. Modular housing, government land and private partnerships will be essential to hitting those numbers apparently. But even if only 75% of the target is hit, that's 1 million houses over 5 years, which would be a significant increase in supply, which is basically what we need right now. 1 million homes over 5 years. But let's be honest, if they bring in 225,000 people per year over the next 5 years, then that means we need 1.3 million houses, 1.25. So it's not even going to keep up with migration alone. Never mind the delta that we're already in at the minute. So next thing to talk about is the Housing Australia Future Fund, also known as the HAAFF, HAAFF. This is a $10 billion fund that aims to build 30,000 homes. 10 bill, 30,000 homes. I think that works out to be $333,000 each as well, doesn't it? The numbers are just all over the shop. But the HAAFF is particularly for vulnerable Australians. These homes will support women and children escaping domestic violence, older Australians and frontline workers. I think it's going to be a challenge delivering them for 333 grand each. Again, you can't even build a house of that, never mind get the land in there as well. But I don't know if you've seen on social media just recently, our property management business Living Rooms has partnered with a company called Worthy, and Worthy are a company that relies on donations to help people escaping domestic violence, so females and children escaping domestic violence. Because of the size of our business now and the volume of furniture that we supply and install, and sometimes people, for any reason, we might have an oversupply of furniture. We've also always got spares and stuff like that, and over the last 7-8 years we've accumulated quite a lot, and we had a storeroom in Osborne Park that was just chocker full of gear, so we donated all that to Worthy, and the owner of that was absolutely blown away that we had such good generosity with us. They also partner with people like Koala, who supply mattresses, and got some really, really good partnerships. And, what we donated was probably nothing compared to some of these other companies. But I'm going to try and get my wife, Joanna, to record a podcast with the owner of Worthy. In fact, I'm going to try and get my wife to record more podcasts with some of the things that she's doing, because she's got the biggest heart I've ever seen in my life, and she's always connecting with people that she can help. And I think we need to get some of these people on the podcast to talk about what they are doing, the problem that they're trying to solve, and not really how we're helping them, just so that you can understand some of the problems that are out there right now. So back to the HAAFF. States all across the country are vying for their share of the fund. Early projects greenlit in Queensland, Victoria and South Australia, but the rollout will need to accelerate, and rising building costs may force the government to top up the fund or shift towards subsidising rents rather than direct builds. Now, we have applied to the HAAFF for some funding to build some HMOs, but apparently you need to be a community housing provider or some sort of government entity to access that funding. It's actually really tricky to get unless you're a not-for-profit or a government entity or a community housing provider. It's very, very difficult to get access to it. Did have a meeting with, if you remember, Robert Pradlin, that we recorded a podcast with a few months back called From Housing All Australians, and they have now put together a new Western Australian committee or board, and their new chair came in to meet myself and Joe, and I think Joe's going to sit on their committee because I just don't have any time at the minute. So I think Joe's going to sit on the committee of Housing All Australians. Housing All Australians are now they always have been a charity, but they are now trying to get access to funding from the HAAFF to try and house more people, which is incredible. But Robert Pradlin, what a great guy he was. You could just hear the passion in his voice. I just loved what he did. The shared equity scheme is the thing that Labour have already got out there. This is the Help to Buy, and this is their kind of landmark initiative for first home buyers, which allows eligible Australians to buy with just a 2% deposit, and the government take up to a 40% ownership of the property. And what this does is reduces upfront costs, helps the buyer avoid lender's mortgage insurance, and also helps buyers break into the market sooner, which is great. $500,000 property, 2% deposit. What's that, 10 grand? It's incredible. The problem is it's capped at 10,000 spots per year, and it doesn't actually fix supply because they have to buy established properties, from what I understand. There's also a debate over whether it will inflate prices at the entry level by boosting demand. Nonetheless, it'll give thousands of Australians a way in, especially in areas where prices are still within reach. What's class is in reach nowadays? Who knows? They've also got the Commonwealth Rent Assistance increase. So this is the largest increase to this assistance in 3 decades, and it's already being felt by low-income tenants, with rents surging 10 to 15% in some areas. This boost provides short-term relief, but doesn't again solve the supply crisis. So it's like a band-aid for affordability pressures, but a much-needed one in my eyes. So there's some pretty cool things that they've got out there. There's the trading investment. Labour has committed 78 mil to train more construction workers. 78 million to train more construction workers. That's a staggering amount of money, isn't it? This includes apprenticeships, trade schools, visa streamlining for skilled migrants. The construction industry is also being hobbled by labour shortages, and without more workers, all the funding in the world won't get any houses built. So yeah, the thing is, and I've had this conversation, I think I had it with Michael McGowan from the HIA, and we talked about like the lack of apprenticeships coming through right now. It's because being a bricklayer is probably not as sexy as being a YouTuber, is it? Or being a plasterer isn't as good as being a digital nomad working from your laptop in Bali, like everybody seems to want to do nowadays. But yeah, we need more tradies, and we've shifted from that industrial sort of revolution to the online sort of techie revolution, if you want to call it a revolution. But it just means that a lot of people aren't even considering apprenticeships and stuff. And look, and many of my friends have got really good lives out of being apprentices and learning a trade, and it gives you the foundation for other things in life. It also gives you a strong income, almost guaranteed work as a tradie, as long as you're good at what you do and as long as you've got initiative and show a little bit of determination. And if you save your money and start investing, you don't have to be a tradie forever, but we do need more of them. So it's either train them as they're coming out of schools, or we bring them in from different countries, which is what we're doing at the minute. Training is underway, but it's a long-term play. I expect to see benefit over the next 3 to 5 years as the new pipeline of skilled workers enters the market. Then we've got the build to rent support. So Labour is promoting institutional investment in large scale rental development, offering tax concessions and faster approvals. Build to rent has seen explosive growth in markets like the US and the UK, and Australia is slowly catching on. However, it's just so expensive to build apartments right now that unless you are Paul Blackburn, who builds high-end apartments in places like Cottesloe, Peppermint Grove and Subiaco, it's really hard to make them stack up unless you're in the western suburbs of Western Australia right now. So the build-to-rent support gives renters professionally managed high-quality housing while offering investors long-term stable returns. And projects are already underway in Melbourne and Brisbane, and this sector is likely to explode in the coming years as super funds and global capital move in. I'm hoping to have some news to give you on that very soon, as we do build-to-rent, but it's on a smaller model. Who knows? Watch your space. Okay, so that's what's already out there and active or in the middle of being rolled out right now, but being planned or being accelerated post-election is fast-tracking planning approvals. So one of the biggest barriers to building is council red tape. Labour is planning a national approach that links federal funding to housing approvals, and if local councils want more money, they'll need to approve more developments, which is interesting, right? However, if it costs so much to build these houses right now, it's very hard to get even a development approved site to stack up on a feasibility. Not always, but it is very, very difficult. And yeah, they can approve as many developments as they want, but if the feasibility doesn't stack up, no one's going to be building, which is why a lot of apartments still are not coming out the ground right now, especially in Western Australia. So the fast-track planning approval thing mirrors recent UK reform and has strong support from the property industry. Get your words out, Mr. Gibb. If successful, it could cut months from approval timelines and incentivise medium-density infill development in underutilised urban areas, which is good. This is what we need. More housing, more infill, more medium and high density. Also, in the planned or being accelerated post-election is expanded use of federal land for housing. Labour plans to unlock government-owned land for affordable and social housing. Think old defence sites, unused transport corridors and surplus federal assets. So this reduces land acquisition costs, allowing homes to be built more affordably, and this could be how they are building or going to be building all these social houses for $333,000. If they already own the land, that's one way that they could be doing it. Locations haven't been fully disclosed yet, but inner suburbs of capital cities and regional hubs near rail or service corridors are likely targets, so expect announcements soon on how that is going to roll out. Also in the planned or being accelerated is enhanced infrastructure investments. Labour plans to tie future infrastructure funding to housing. That means if a state wants a new train station or highway or any sort of major infrastructure, then they'll need to show how they'll support housing supply nearby. So as you can see, it's very heavily weighted in terms of housing and housing supply. This obviously creates opportunity for developers and investors to target growth zones where transport and public amenity will supercharge capital growth. It also ensures new homes are built where people want to live, work and commute, which is, guess what? Exactly what the HMO is, right? And then let's talk about, that's everything that's planned or being accelerated. Now we've got the supply versus demand issues. As we know, Australia is falling short of its housing target of around 60,000 homes per year. Construction approvals are down due to high interest rates, labour shortages and material costs, and even when projects get approved, they're taking longer to get to ground and even come out the ground. Now, at the same time, migration is surging. As we've spoken about, rental demand is spiking due to the demand, and vacancy rates are below 1% in most major cities. Guess what? This creates the perfect storm. Too many people, not enough houses. It's why everything's going bonkers right now. House prices going up, rents are increasing, and it's why if we just keep building the same thing, we'll keep getting the same result. It's Einstein's definition of insanity, isn't it? If you keep doing the same thing over and over again, you're going to get the same result. We keep building all of these single-storey 4, 5 and 6 bedroom houses and expect to solve the housing crisis when we could be building 5, 6 bedroom houses, putting multiple tenants in there and kind of artificially increasing the density of the land. It's helping us get more people into areas, build community, affordability, convenience and community. God, I'm not saying the HMO is the answer, but the world needs more of it. Western Australia needs more of it. Melbourne and Brisbane have seen this a long time ago and put policy in place, and a lot of investors invest in them areas right now. Perth, yes, we've had a good run, but I still believe Perth is got some legs ahead of it. Last Wednesday or Thursday, we got invited to a presentation by Judo Bank, and Judo is a bank that we've been working with for a short period of time now. They're a very progressive bank. They love backing small businesses, and they invited us to a presentation. I say us, myself and Troy. We went to a presentation about the economic outlook and the tariffs that Trump's been putting in place. And it was ran by their chief economist. Can't remember the guy's name now, unfortunately, but he used to work for ANZ Combank, and now he's working for Judo. So that kind of shows you how progressive Judo are when they're attracting people like him. And this guy basically talked about all the different things that are going on in the world and just said Western Australia should be safe. All the things that happen out there are probably bullish for making him bullish on Western Australia. And he thinks that Brisbane and Perth could overtake Melbourne as the second and third biggest cities in Australia. What an interesting bold statement that was from that man. But after the information that he showed us, the stats that he showed us, the numbers that he showed us, made me listen even more. He was a very, very smart guy. So why does all of the things that I've just told you now favour the investor? Who've still got high interest rates, which are still smashing negatively geared properties, but our properties, still cash flow positive, everything. I haven't had one investor reach out to me and say, Neil, I'm negative cash flow. Yes, Neil, my income's dropped, but I'm still positive cash flow, which is great. So cash flow is king, first and foremost. Number two, if you can target undersupplied markets, like anywhere right now, absolutely anywhere. Everywhere's undersupplied because we've got migration going on. So basically, you can pick the right market. And look, there's various forecasters and experts out there saying different things, and they've all got different ideas about what's going to work and what's not. I am in a position where I get to speak to lots of investors on a weekly basis, and I have some interesting conversations, because when people say one thing, I always ask why. I never try to correct them or say this or say that. It's like, that's interesting. Why do you believe that? Or why do you understand that? Or what's your thought process there? And then I get to understand how them people are thinking. Here's the thing. I've met, let's say, of 100 investors. It's a very equal split across all different states about where people are still talking about Brisbane. People are talking about Melbourne as the next market to boom, which I believe it will, but I believe it's too early. People are still talking about Perth, and the runway's got ahead of it. But not a lot of people are talking about Sydney right now, which is interesting. But, Sydney's the most unaffordable city in Australia right now. The yields are low, so can you get capital growth in that city? Who knows? Again, why does this savour the savvy investor? Secure fixed finance. So if you can lock in a loan at today's rates on a cash flow positive deal, happy days. But we're expecting rates to come down, right? So if you're looking at a feasibility that works today, imagine what it's going to look like at the end of the year when rates come down, when cash is cheaper. I absolutely think that we're expecting 25 basis points at the next RBA cash meeting. Next time the RBA meet, we're expecting to drop 25 basis points. Some people are saying that it could drop 50 basis points. So this is where it gets interesting, right? Because as I wrap this podcast up today, I'll say this: Labour is back with a plan. As you can see there, we spoke about all them different things that are going on, but plans do not build houses, right? Builders do, tradesmen do, and right now Australia is crying out for supply. Investors who understand the system, who play where the government is going, not where it has been, will win. Migration is rising, supply is lagging, and the rental market is red hot. If you've got equity, you've got an opportunity. If you've got cash or equity, you've got an opportunity. If you can access the equity, you've got an even better opportunity, because a lot of people that we spoke to over the last 12 to 18 months are equity rich and cash flow poor. And what that means is they couldn't access the equity in their property because they didn't have the income to service the loan that loan would have went to when they accessed that equity. Equity rich, cash flow poor. Here's the thing, equity does not pay the bills, cash flow does. Here's where it gets even more interesting. The Reserve Bank of Australia is expecting to cut rates by at least 25 basis points, potentially even 50 basis points. That means cheaper borrowing, which means better yields and renewed buy activity. With everything I've discussed today, migration, rental pressures, government incentives, if you add cheaper money to the mix, it's just going to light the fuel underneath the market. And it's going to get very, very exciting for property investors. Anybody that owns a property is going to make money. Anyone that owns multiple properties is going to make even more money, because that is the power of leverage. But here's the thing, it's not going to be exciting for everybody. For renters, people that are renting, people that are moving to the country and needing to rent or needing to get into the market, and you don't have much money, the outlook looks grim. Growing demand, high vacancy rates and rental increases will continue to bite. First time buyers, it's a little bit more nuanced because of the Help to Buy shared equity scheme thing. Offers a path in with 2% deposit, no LMI, blah. But only 10,000 places per year. Let's split that out across 4 major cities. Let's say 5. So Perth, Sydney, Melbourne, Brisbane, Adelaide. 5, so that's 2,000 places per year. It's not massive, is it? And let's be honest, we're not going to get 2,000 each. Sydney and Melbourne will probably get the bulk of that. Perth will probably get 500 if we're lucky. But this, even with that, they're going to find it hard to secure a property, especially in high demand suburbs, because affordability is still the key, right? So if these people have got, looking for a $500,000 property, they've got a 10k deposit, they're not going to pay any LMI, then there's only a certain amount of suburbs that they're going to be looking in, and that's where a lot of other people are going to be looking in, because interest rates are still high, disposable income is still low, and a lot of people are still watching what they spend. So while some people will benefit from these programs, others will still be priced out as demand continues to outpace supply. So here's the thing, I don't think now is the time to wait for a perfect deal, because perfect doesn't exist. You always say progress over perfection or momentum over perfection. It's just, if you sit around waiting for the perfect deal, you're just over-analysing things and you're just procrastinating. So perfect doesn't exist. What does exist is urgency, strategy, education. These are some of the things that I'm helping you with this podcast, and there's many other people out there that are talking about and giving away free information. So you can either sit on the sidelines and prices climb and yields shrink, or you become part of the solution and get paid whilst you do it. You know what I say about people, when you're sitting on the fence, you just get splinters in your bum. There you go. So hope that helps. Thank you for joining me on the HMO Property Court. Thank you for following our content. Thank you for liking our stuff. Do us a favour, give us a like on the podcast, whatever you're listening to right now. The more likes we can get, the more shares we can get, the more followers we can get, the better guests I can bring on the show. I know it's been a lot of me lately. I have been a little bit lazy reaching out to people. However, I have reached out to a lot of people over the last few days, and I've got some really, really good guests lined up soon. So have a great time, everybody. Thank you for joining us. Take care. And remember, every master was once a disaster. Every winner was once a beginner.
Thanks for watching. Make sure you tune in the same time next week so you can stay up to date with all cash flow positive property updates.